Hello, my name's Josh Mahony, Chief Market Analyst at Scope Markets. This is the week ahead for the week starting Monday, the 22nd of July. And certainly this comes off the back of a week that had plenty of fireworks, whether it was the likes of Canadian inflation moving into negative territory on the month, whether we saw the UK inflation coming in higher than expected and remaining flat essentially at 2%, but also the likes of services and core CPI remaining elevated. We, of course, saw the attack on Donald Trump leading into the week. So we saw this Trump trade coming into play off the back of an idea that Donald Trump is likely to win the next election. We've seen people moving towards the possibility of Joe Biden stepping aside. So now we've got big question marks around that. And we've seen a Mag 7 sell-off that culminated in a Friday that saw a massive IT outage instigated by the likes of CrowdStrike and most notably Microsoft. Given the size of that company, it really does continue that theme of tech weakness. Now, as we move into the new week, I've provided an earnings preview, and that highlights the fact that this week brings the beginning of those big Mag 7 names, the first two names coming up with Alphabet and Tesla both reporting. And so the fears around Mag 7 come into light. Are they justified? Are they not? But certainly the economic data we're talking about today are also paired off against their earnings data to really get a big picture of exactly how things are going to be playing out, because we're going to have impacts on both sides. If we see tech weakness, that's likely to overshadow some of the economic data. If we see significant weakness in terms of, say, Alphabet earnings, that could really hurt the Mag 7 names and could undo some of the moves that we're seeing elsewhere within the markets. But there's still plenty to look at for this week. Here's the breakdown of some of the main events over the course of the week, really getting up and running in a meaningful manner on Wednesday. We've got a couple of readings coming out of Germany. Highlighted here is the PMI, manufacturing PMI from Germany, but we have a whole host of PMIs released over the course of the day. The Bank of Canada rate decision expectation that we see rates remain steady. But it's worth bearing in mind with the disinflation that we saw last week, there is an expectation that soon enough we see the Bank of Canada cut once again. Elsewhere, we've got a big focus on the US. You can see here durable goods. So we've got core durable goods, GDP, the core PCE figure, the personal spending, personal income, the unemployment claims, all of that over the course of 2 days at the back end of the week. And so that's where we're going to kick off. Is a breakdown of some of the metrics that we'll be looking out for over in the US. The big focus here is, like I said, Thursday and Friday, but we lead into it on Wednesday, and Wednesday is PMI day, essentially. We're going to see a whole host of PMIs kicking off in the likes of Australia and Japan, moving on throughout Europe, the Eurozone, Germany, France, UK, and ending up over with the likes of the US. So that's going to be key, but really the big readings are going to be the GDP figure coming out on Thursday. Because of the fact that this is the first metric for the second quarter, the next two readings that we're going to see are going to be revisions of this initial figure. So generally, you'll see greater volatility around that first estimate and the later revisions less so. Markets expecting to see a rampant 2.5 move. I say rampant, if we're looking at the figures that we had seen previously, it's a recovery back towards those kind of levels, but certainly moving in the right direction. Now, could a strong surge in terms of the GDP figure point towards a potential, essentially an easing in terms of expectations for the Federal Reserve to cut in September? Because right now, markets really do think that that's nailed on, in part, in no small part, down to the inflation gauge that we saw recently. So that GDP figure is going to be really key. We've also got the core PCE price index figure here on Friday. You can see here the forecast is 2.5, down from 2.6. And so this is, and I'll get into it, this is the key metric that the Federal Reserve utilize when they're following inflation. So the closer this gets to 2%, the more justified it is for them to cut interest rates. And we can see that here in terms of the core PCE figure, 2.57, the last figure, markets expecting the reading back down to 2.5. And as we see, they're moving in the right trajectory. But by and large, if you're looking at, say, CPI, core CPI, they've been sort of, certainly the CPI figure has been largely flatlining over the last year. You can see it sort of rotating, but we haven't seen a meaningful break lower from the sort of 3% kind of area. Core CPI 3.3 at the moment, but it's at least on a downward trajectory. Core PCE has been on a sustained move towards the downside, and if we do see further disinflation, that's likely to heighten calls for an interest rate cut from the Federal Reserve. Let's take a look at the chart. So I'm just going to bring up the chart for. Here we go. Just going to bring up the chart for the S&P 500. Now, I just wanted to keep on some of the analysis that I put together for the earnings preview, because I think it's interesting, because we've, of course, got this sort of period of weakness that's coming in to play at the moment. This is the daily time frame. So we've seen some weakness falling back into the 61.8 fib at the moment. But we're at the sort of inception of earnings season. And in the past, this has led to a pullback before we sort of bottom out here. We can see here we've got Microsoft earnings on the 25th of April, and that sort of period really then saw us rally onwards and upwards, rounding off with Nvidia at the back end. You can see here there's an expectation that we're potentially going to see something similar, right? Possible weakness into the earnings, but of course we have got Alphabet earnings, so that's going to be a key one to look out for. But Microsoft, of course, the most valuable company of the lot. So if we see a continued downside, possibly we could see another maybe week or so of weakness, and then possibly start to bottom out if we see something similar to last quarter. So aside from earnings, if we're to look at the chart itself, you can also see, let me just go on to say the 4-hour chart. We might be able to strip some of this out. So you can also see here that we're very clearly within a nice uptrend of late. And so the pullback that we've been seeing looks to be a potential buying opportunity. So if we break down through this perspective, and I say perspective, it's only got 2 touches, trend line, and crucially below this 5447 support level, then that points towards potential wider pullback coming into play. And until that happens, the pullback we're seeing at the moment could potentially represent a buying opportunity. Now, like I said, I think markets are likely to remain a little bit hesitant as we lead into some of these big tech earnings. So there's a possibility that even if this does form a bottom, it could be a sort of consolidation into that area rather than just a big spike up from the lows. But certainly those earnings should give us a lot by way of sort of telling us where we go from here. But the trend still remains in play unless we see that 5447 level broken. At the moment, we're at the 61.8 Fibonacci level, which has been respected and tagged. But below that, we've got 5,500, which is the 76.4. So I remain bullish for this market, but I'm also aware of the question marks that are currently in play, and that could cause some hesitation. Hopefully, earnings from Alphabet in particular, and the likes of Visa, because I think that gives a good lead on expectations in terms of the consumer. If we see strong numbers for them, then that could help essentially mark the bottom following the pullback that we've been seeing at the moment. A break below 5447, like I said, would be required to indicate a more bearish picture. Now, I just wanted to bring up the outlook in terms of the Federal Reserve. Of course, given the fact that we're talking about economics here, we're talking about GDP. If it comes in strong, does the Fed even have the justification to start cutting interest rates? If we see inflation remaining stubbornly high, again, do they have the justification? If we see core PCE moving towards the downside, then people are going to feel even more confident following that recent decline in both core and headline CPI. Well, markets are feeling very confident of a September rate cut, not of a July rate cut. And you can see here at the back end of this month, 31st, just a 5% chance attributed to a rate cut. But September currently priced in at 96% that we have rates cut. That is the kind of thing that is likely to shift as we see, these expectations will shift as we see the data coming in over the course of the week. And arguably, if you're going to say it's going to move in one way, it's unlikely to move more in the direction of a rate cut. So you're likely to see bigger volatility away from shifting away from September rather than shifting towards September. Although it's worth bearing in mind that you also see shifts at the back end. So if we see a dramatic fall in terms of the core PCE figure, you're likely to see people expecting to see more rate cuts and more quickly. And if you're looking in terms of the impact on the S&P 500, that should come to the benefit of the S&P 500. Bear in mind, we have recently been seeing this rotation coming into those unloved stocks. And so the likes of the Russell 2000, the likes of Dow Jones Industrial Average, also really key markets to be looking out for as potential benefactors of interest rate cuts going forward. I have provided a big outlook in terms of the potential rotation away from the S&P 500 and NASDAQ towards the Dow, towards small caps of the Russell 2000, sort of middling names, industrial names. We've also got this whole Trump trade where we've got the move towards companies that could benefit if they raise tariffs. So a lot going on at the moment. And I've done a big video that should highlight all of these themes and give you a little bit more clarity on the matter. So make sure to check that out. Next, we're looking out for the Canadian interest rate decision. This comes on Wednesday. Markets expecting it to remain at 4.75. If we look at what else we've got over the course of the week, we've got some weekly earnings data expected to decline to 3.5% on Thursday. But by and large, a big ticket item comes on Wednesday. And we can see here in terms of expectations, markets really expecting that we're going to see no change here, and no change for some time yet. That comes despite the fact that if you look at inflation over the course of the last week, let me just bring up Canadian inflation. The monthly figure came in at minus 0.1. The annual rate came in at 2.7. So 2.7, we've been middling in the mid to high twos for quite some time now. At least last month, we did see that nice minus 0.1 reading, but it comes off the back of three in particular, particularly strong readings: 0.6 in March, 0.5 in April, 0.6 in May. So significant inflation pressures at the beginning of the year. They're starting to abate, but clearly not necessarily doing enough to point towards the Bank of Canada doing anything else on the interest rate front. They already have cut interest rates, and it clearly appears to be the case that markets believe that they're done for now. Will we see this meeting change their mind in any way? Well, it remains to be seen, quite frankly, and certainly coming off the back of that latest inflation data, there's a possibility that people are going to feel more confident in that. Now, we're seeing here some upside over this course of, let me just grab the chart for you here. We can see here in terms of the likes of dollar CAD here on the weekly time frame that we've been seeing a rebound of late, in part down to the fact that equity markets showing some weakness, so the US dollar is coming into strength as well. We can see that by and large we have been sort of rotating over the course of recent months, where we find support here at, let me just change that to here, 1.36, and sort of resistance up around 1.8 essentially. So we're waiting for that breakout, but like we can see here, we're in a wider range as well. So you've got the top end of this range, well, all the way up to 1.397. But by and large, we're looking here for around about this kind of area here as well, 1.387. So we've got this big range in play as well, and we're around the top end of it. Quite whether we're going to start to roll over from here remains to be seen. But I would say that it probably looks likely that we're going to see a move back towards the top end here if we were to see a continuation of that range. Of course, a breakup through this resistance level around your 138. Some will be looking for that as a bullish signal. But of course, if we look back historically, we've still got this massive 386 level above there. So certainly in terms of the Bank of Canada, if they're coming out with hawkish statements and we're looking towards the Federal Reserve to potentially cut interest rates, then you could say, well, there's a possibility that we could see this market rolling over once again. But if the latest CPI reading of minus 0.1 emboldens the Bank of Canada to come out with a relatively hawkish statement and point towards further interest rate cuts, you could see this pair moving upwards towards that 1.38 mark once again. And finally, let me just bring up the data, even though there's not a huge amount of it, and that's for the Eurozone. I say there's not a huge amount. It's essentially the PMIs, right? We've got the big PMI numbers coming out on Wednesday. We've also got some German data, consumer confidence, business climate, current conditions, expectations on the EFO. We've got an appearance from Christine Lagarde on Thursday. And this comes off the back of the ECB meeting that saw them hold. That was expected. But it was, to some extent, a hawkish hold. It wasn't necessarily the likes of Christine Lagarde laying the groundwork for a September rate cut. And so people are a little bit concerned. Now, the question mark here is whether we're going to see the ECB cutting rates. Now, we have got the Jackson Hole Symposium. If we do see an appearance from Christine Lagarde at that symposium, historically, it has been the kind of meeting where central bankers have laid the groundwork for an interest rate cut. So that could be the time where she is a little bit more candid about it. For the time being, it's all about being data dependent. She's saying that she's essentially not doing forward guidance anymore. And so we need to really follow the data. Are we seeing economic weakness? Are we seeing disinflation? Well, disinflation, yes, to a degree. Still above target, but we're not that far away from it. In terms of the economic side of things, well, that's where these PMI readings come in. You can see in terms of expectations, manufacturing expected to tick up a little bit, composite expected to tick up a little bit, services expected to tick up a little bit. This is across the Eurozone. In terms of Germany, which has been a real sort of bad news story, it's all about manufacturing, which remains in the doldrums, but expected to tick up a little bit again, 43.8 expected from 43.5. So marginal gains expected across the board. Whether that's enough to start saying, oh, the economy is in a great position, we don't necessarily need the ECB to act, that remains to be seen. Now, in terms of expectations from the ECB, we can see that September now, it's 2/3 to 1/3, essentially, 66% chance of a rate cut, according to the Icon platform. And then beyond that, how do things stand for the rest of the year? Well, another rate cut expected before the end of the year. So 2 rate cuts in 3 meetings expected from the ECB. Now, I wanted to bring up Euro Aussie because, interestingly enough, we've been seeing a rally for Euro Aussie, despite the fact that we're expecting to see the ECB cut rates and we're expecting to see the RBA hold on and pause any moves on the rates until next year. But we've been seeing some strength, in part down to the weakness that we're seeing in terms of GDP coming out of China. Of course, the Australian economy very much reliant on that. So we've been seeing some weakness in the Aussie. Nonetheless, if you look in terms of the trend, this recent rally could be a precursor to us rolling over once again. So I just wanted to highlight that. And this is the kind of thing that we'll be able to follow and say, are we seeing the signals to say that this is rolling over? In terms of the near-term trend, we've rallied up through your 61.8. We've got above that 1.623, which is your 76.4 Fibonacci level. In terms of near-term price action, we remain within a bullish trend, and we'd need to see a breakdown through your key sort of swing lows. Your initial one would be 16232, but really the 1.618 sounds like a Fibonacci level. That level is going to be really key. As things stand, that's the key swing low that if we break that, then we'll see a potential double top formation and the bears come back into play once again. And you'll be able to craft something around that. But certainly from a wider perspective, this looks like the kind of market that could roll over once again. If we see relative weakness in terms of the PMIs, that could point towards greater confidence in those 2 rate cuts this year from the ECB. And as we get closer to that September meeting, yes, we saw this hawkish hold from the ECB, but at that Jackson Hole Symposium, if they lay the groundwork for an interest rate cut in September, or any of these other data points that point towards the ECB cutting rates in September, and then once again in December, that could soon enough spark this market into rolling over once again and continuing the bearish trend that has dominated essentially the last 6 months, 5 to 6 months for Euro Aussie. So has been on a rise of late, but we're looking out on an intraday basis for this to potentially roll over. And key to that would be a breakthrough 1.623 and 1.618 for the Euro Aussie.